President Trump has now officially signed an executive order to launch a national AI science program known as the Genesis Mission. The text of the order argues that the race for global technology dominance in the development of AI requires a historic national effort comparable in urgency and ambition to the Manhattan Project. This order launches the Genesis Mission as a dedicated, coordinated national effort to unleash a new age of AI-accelerated innovation and discovery that can solve the most challenging problems of the century.
The U.S. economy is growing on paper, shrinking in reality, and the gap between the two has never been more dangerous. While the administration celebrates GDP growth exceeding 4% in the third quarter with projections approaching 5% for the fourth, these numbers have become increasingly disconnected from the economic reality experienced by ordinary Americans. This isn't just a statistical quirk, it's a fundamental transformation in how the economy operates, who it serves, and what happens to everyone else. Strip away the massive capital expenditures pouring into artificial intelligence and data centers, and GDP growth approaches zero. The expansion that does exist concentrates in three narrow channels: healthcare for an aging population, government spending, and stock market returns. This creates an economy running on only a couple of cylinders. It primarily benefits wealthier, older asset holders, while the burden falls on low-income workers, small businesses, and young people entering the workforce. The disconnect reveals something more troubling than a temporary imbalance. It signals a structural shift in the American economic model itself. The AI investment boom sits at the center of this transformation. Meta, Alphabet, and Amazon have collectively announced $650 billion in capital expenditures for 2026 alone.
Amazon announced on Monday that they will spend up to $50 billion to expand their AI and supercomputing facilities for U.S. government customers. The expansion will begin next year and is expected to add a total of 1.3 gigawatts of AI capacity to the AWS regions that service government demand.
These aren't modest research budgets. They represent the largest concentrated investment in a single technology sector in modern history. Yet the market's reaction has shifted from enthusiasm to anxiety, and for good reason. The investment thesis contains an impossible contradiction. If the AI race succeeds, it means widespread labor displacement. If it fails, trillions of dollars vanish into failed infrastructure.
I could have it go up or go down like a yo-yo. I want it to be just seek its own level, which is the fair thing to do. I could have it go up or go down like a yo-yo.
There's no scenario where this ends without significant economic disruption. This tension isn't theoretical anymore. When Anthropic released its new AI automation tool, software-as-a-service platforms experienced a massive sell-off. The tool demonstrated the ability to complete complex clerical tasks traditionally performed by entry-level employees, tasks that represent the entry point into the professional workforce for millions of young Americans. The Goldman Sachs Software Index has seen roughly $2 trillion wiped from its value since its highs. The private credit market, heavily weighted towards software investments now perceived as vulnerable to automation, has taken similar losses. Markets are pricing in a future where an entire category of white-collar work simply disappears. What happens to an economy where growth requires fewer workers every quarter?
We'll be announcing a new statistician sometime over the next 3-4 days. We had no confidence. I mean, the numbers were ridiculous, what she announced, but that was just one negative number. All of the numbers seem to be great.
This isn't a distant concern. It's unfolding in the labor market data right now. The employment picture presents the ugliest aspect of the current economy. Data from ADP and Challenger, Gray and Christmas paint a picture of systematic contraction hidden beneath headline employment numbers. 2025 recorded the highest layoff total outside the COVID pandemic in a decade. In January alone, U.S. employers announced 108,000 job cuts. That's a 118% increase from the previous January and a 200% increase over December. This signals not a cyclical slowdown, but a structural reallocation away from labor-intensive roles. The hiring side tells an equally troubling story. Private employers added only 398,000 jobs in 2025. That's a sharp decline from the 771,000 jobs added in the previous year. January's growth registered a mere 22,000 jobs, barely enough to account for population growth, much less absorb new workforce entrants or provide opportunities for those seeking better employment. Job openings trended down by nearly 400,000 in December to 6.5 million. Year-over-year openings are down by almost a million. These aren't marginal adjustments. They represent a fundamental tightening of labor market access. Even positive productivity data carries negative implications for workers. Productivity measures output per worker, doing more with less. When productivity rises while employment stagnates or falls, it signals that companies are achieving growth through automation and workforce reduction rather than expansion. Each productivity gain announced as economic good news translates directly into fewer jobs needed to generate the same output. The market understands this dynamic perfectly. That's why productivity productivity announcements often trigger gains in equity prices while labor market indicators deteriorate. Once job openings fall below replacement levels, recovery becomes mathematically difficult without either massive fiscal stimulus or wage deflation. The current trajectory suggests we're approaching exactly that threshold. The ratio of job openings to unemployed workers has fallen steadily. This eliminates the leverage workers had to demand better wages or conditions. This isn't a temporary dip. It's the labor market adjusting to an economy that increasingly generates returns without requiring proportional human input. The administration has attempted to counter these trends through industrial policy, specifically by engineering a weaker dollar, down 10%, with the goal of boosting manufacturing competitiveness and tourism. The theory held that a cheaper currency would make American manufacturing more competitive globally and attract foreign visitors. In practice, the policy has failed to deliver on both fronts, largely due to inconsistent execution and a lack of coherent long-term strategy. Despite the weaker dollar providing a theoretical advantage, the U.S. lost 70,000 manufacturing jobs in 2025. This represents a complete failure of the policy's central objective. Investors remain hesitant to commit capital to new manufacturing facilities. They can't predict whether the administration might suddenly impose 100% tariffs on their suppliers, start trade wars that disrupt supply chains, or reverse course entirely on industrial strategy. Capital doesn't flow toward uncertainty. It demands predictable policy environments before committing to long-term fixed investments like factories and equipment. Supporters argue these policies require time to show results. However, capital markets are signaling skepticism now, not patience. The tourism failure proves equally stark. Global tourism reached record highs last year, yet the U.S. stood as a substantial outlier. Travel to the United States dropped 4.2% in 2025, resulting in a $50 billion loss in visitor spending. This occurred during a year when international travel overall surged. The U.S. didn't just fail to capture growth, it lost market share in an expanding industry. The perception of the nation as hostile, whether driven by policy, rhetoric, or international reputation, has translated directly into reduced economic activity in tourism-dependent regions. The hospitality sector, which provides millions of entry-level jobs, has contracted precisely when the administration claimed to be helping working-class Americans. This brings us to the fundamental transformation that explains why traditional policy tools keep failing. The U.S. has shifted from a labor-oriented economy to an asset-oriented economy. Bond traders like BlackRock's Rick Rieder have articulated this transition explicitly. In a labor-oriented economy, growth translates into wages, and wages drive consumption. In an asset-oriented economy, consumption is driven by the upper end, those who own stocks, real estate, and other appreciating assets. Meanwhile, the middle and lower classes increasingly rely on credit to maintain living standards. This shift explains why the stock market can surge while median household financial security deteriorates. Asset owners benefit from corporate profits generated through automation and workforce reduction. Workers experience this same dynamic as job insecurity and wage stagnation. The two groups inhabit the same economy, but experience completely opposite outcomes from identical underlying trends. GDP growth captures the gains of asset owners while remaining blind to the deteriorating position of wage earners. Administrative attempts to appeal to working-class voters through policies like no tax on tips or no tax on overtime prove largely ineffective within this framework. The overtime tax provision, for instance, only applies to the time-and-a-half portion of overtime pay. That means it impacts just 1/3 of actual overtime compensation. More fundamentally, these benefits mean nothing when hours worked are declining and the tourism-dependent hospitality jobs that generate tips are disappearing. You can't exempt income from taxation when that income is vanishing in the first place. The credit dependency of lower and middle-income households creates its own dangers. As asset prices rise and wages stagnate, the gap gets filled by debt. Auto loans, credit cards, student loans, and increasingly buy now, pay later schemes for basic consumption. This works as long as employment remains stable and interest rates stay manageable. But in an environment where job security is declining and the Federal Reserve faces persistent inflation pressures, the sustainability of this model comes into question. A shock to employment or a sustained period of higher interest rates could trigger cascading defaults across consumer credit markets. The private credit market's vulnerability adds another layer of systemic risk. Shadow credit giants have accumulated massive positions in software companies now threatened by AI automation. These aren't publicly traded companies with transparent balance sheets. They're private equity investments with leveraged capital structures and limited liquidity. If the AI displacement thesis proves correct and a significant portion of software companies lose their business models, the write-downs will ripple through the private credit system. This creates potential for financial instability that isn't captured in traditional banking sector stress tests. The concentration of economic gains in AI infrastructure investment creates additional fragility. If that investment thesis breaks, whether through technological disappointment, regulatory intervention, or market saturation, There's no secondary growth engine ready to absorb the slack. The economy has become dependent on a single sector's capital spending to generate headline growth numbers. That's not diversification, it's concentration risk at a macro level. What makes this moment particularly precarious is the absence of obvious policy solutions. Traditional Keynesian stimulus requires fiscal space the government doesn't have, with deficits already elevated. Monetary policy faces constraints from inflation concerns and limited effectiveness when the core problem is structural rather than cyclical. Industrial policy has proven ineffective without consistent execution and investor confidence. Tax cuts disproportionately benefit asset owners rather than wage earners, reinforcing rather than correcting the underlying imbalance. The political implications compound the economic challenges. An economy that delivers GDP growth without broad-based prosperity creates a legitimacy crisis. When the official statistics say everything is fine while people's lived experience says otherwise, trust in institutions erodes. This gap between headline numbers and lived reality fuels political polarization, conspiracy theories, and social fragmentation. People know something is wrong, but the experts keep pointing to charts showing growth. This creates a disconnect that undermines the credibility of economic expertise itself. The youth face particularly acute challenges in this environment. Entry-level positions, the traditional pathway into professional careers, are precisely the roles most vulnerable to AI automation. The college graduate who expects to start in a junior analyst or administrative role may find those positions simply don't exist anymore. Without that entry point, how do you build experience, develop skills, and advance into more senior positions? The economy risks creating a lost generation locked out of career pathways that previous generations took for granted. The timeline matters here. Economic transitions that unfold gradually allow for adjustment. People retrain, industries adapt, new sectors emerge. But the pace of AI deployment suggests a much more compressed timeline. Companies are implementing automation tools across entire departments in quarters, not decades. The labor market doesn't have time to adjust organically. Workers in their 40s and 50s can't easily retrain for entirely new careers. Recent graduates can't build experience in jobs that are disappearing as they apply for them. Manufacturing job losses despite currency devaluation reveal how little control policymakers actually have over these structural forces. You can make the dollar cheaper, but if investors don't believe in policy consistency, they won't build factories. You can cut taxes on tips, but if tourism is declining because of national reputation, there are no tips to exempt. You can celebrate GDP growth, but if it's driven entirely by corporate capital spending on automation, it doesn't translate into household prosperity. Traditional policy levers keep getting pulled with diminishing or perverse effects. The financial markets are already pricing in these dynamics. The $2 trillion decline in software valuations represents a collective reassessment of which business models survive the AI transition. The private credit sell-off reflects similar recalculation about risk and sustainability. Bond markets show increased volatility as investors struggle to price long-term growth in an economy undergoing fundamental structural change. These aren't temporary corrections. They're markets trying to figure out what the new equilibrium looks like. The productivity paradox deepens the challenge. Rising productivity should be unambiguously positive. It means we can generate more output with the same inputs. But in the current distribution system, productivity gains flow almost entirely to capital rather than labor. The workers who get displaced by productivity improvements don't share in the gains. They face unemployment or underemployment while shareholders capture the benefits. This creates a situation where economic efficiency and social stability pull in opposite directions. The healthcare and government spending that comprise much of the non-AI GDP growth present their own sustainability questions. Healthcare spending rises because the population is aging and medical costs inflate faster than general prices. Government spending increases are financed by deficits that create future obligations. Neither represents productive investment that generates future growth capacity. They're consumption funded by either transfers or debt. An economy that grows primarily through healthcare consumption and government spending isn't building a foundation for sustained prosperity. The asset orientation of the economy creates a particularly vicious cycle during downturns. When asset prices fall, the wealthy reduce consumption. This reduces employment, which reduces wages, which reduces the ability of lower-income households to service debt. That creates financial stress, which can trigger further asset price declines. The economy has built in a destabilizing feedback loop where the consumption of the top depends on asset values. This makes the entire system vulnerable to market volatility. The international dimension adds complexity. A weaker dollar should boost exports, but it also makes imports more expensive, feeding inflation. Tourism decline despite currency advantage reveals that price isn't the only factor. Reputation, policy stability, and perceived hospitality matter. Manufacturing won't return just because labor costs adjust if the regulatory environment, infrastructure, and supply chains aren't competitive. The U.S. can't simply devalue its way to industrial revival without addressing deeper structural factors. The timeline toward a point of no return deserves emphasis. Labor markets can absorb gradual change, but they break under rapid transitions. When job openings fall below the level needed to provide opportunities for new workforce entrants and those seeking to change positions, the market enters a qualitatively different state. Unemployment may not spike immediately, but labor force participation declines, long-term unemployment rises, and wage growth stalls. Once that dynamic sets in, reversing it requires either massive intervention or painful adjustment through wage deflation and reduced living standards. The AI investment boom will eventually face a moment of reckoning. Either the technology delivers transformative productivity gains that displace massive amounts of labor, or it fails to justify the investment and triggers write-downs across the sector. There's no middle ground where $650 billion in annual spending continues indefinitely without either revolutionary impact or financial correction. That reckoning will define the economic landscape for the next decade, yet it remains fundamentally unpredictable in timing and magnitude. The contrast between headline GDP and lived economic reality will likely widen before it narrows. The forces driving them apart, automation, asset appreciation, market concentration, show no signs of reversing. Policy interventions so far have proven inadequate to bridge the gap. This suggests a period of sustained tension between official economic statistics and popular economic sentiment, with all the political and social instability that implies. The retail investor faces a particularly confusing landscape. Traditional metrics for evaluating market health no longer apply when profits decouple from employment. A company can report record earnings while laying off thousands. Stock prices can surge while the communities where those companies operate deteriorate. The traditional assumption that a rising tide lifts all boats breaks down when the tide only reaches those already in yachts. Small business owners confront their own set of challenges in this environment. Access to credit tightens as banks become more risk-averse. Customer spending power erodes as wage growth fails to keep pace with inflation. Competition from automated solutions intensifies across nearly every sector. The small business that survives requires not just hard work, but access to capital, technology adoption, and market positioning that many simply can't achieve. The geographic dimension of this transition creates additional friction. Coastal cities with concentrated tech sectors capture the AI investment boom's benefits. Manufacturing regions that bet on industrial policy revival see those hopes disappointed. Tourism-dependent areas watch visitor numbers decline while costs rise. The economic divergence between regions accelerates, creating political divisions that map directly onto economic geography. The generational wealth transfer occurring simultaneously complicates the picture further. Baby boomers hold the majority of assets appreciating in value. They benefit from stock market gains, real estate appreciation, and policy designed to protect asset values. Younger generations face higher costs for housing, education, and healthcare while entering a labor market offering fewer secure positions. The intergenerational tension this creates isn't just economic. It's fundamentally about whose interests the system serves. The retirement security crisis looms larger in this context. Workers displaced in their 50s have little time to rebuild savings or retrain for new careers. Pension obligations for public sector workers strain government budgets already under pressure. The assumption that markets will generate returns sufficient to fund retirement looks increasingly questionable when growth concentrates in sectors that don't create broad-based employment. The education system's role in this transition deserves examination. Universities continue producing graduates trained for career paths that may not exist in 5 years. The skills gap widens as technology evolves faster than curriculum. Student debt burdens increase while the return on that investment becomes more uncertain. The traditional promise that education guarantees economic mobility breaks down when the jobs requiring that education disappear. The social safety net's adequacy comes into question. Unemployment insurance designed for cyclical downturns doesn't address structural displacement. Healthcare tied to employment creates additional vulnerability for displaced workers. Retraining programs operate at a scale far smaller than the potential displacement. The infrastructure for managing large-scale economic transition simply doesn't exist at the level this situation may require. The innovation paradox presents another layer of complexity. The same AI technology threatening employment could theoretically solve massive problems in healthcare, climate, and resource allocation. But if the benefits concentrate among capital owners while the costs fall on displaced workers, the net social impact becomes negative even if the technology itself is beneficial. The distribution mechanism matters as much as the innovation itself. The political response options appear increasingly limited. Proposals for universal basic income face implementation challenges and political opposition. Job guarantee programs require government capacity and funding that may not materialize. Worker retraining at the necessary scale has never been successfully executed. The policy toolkit doesn't contain proven solutions for managing technological displacement at this speed and scope. The international competitive dimension adds pressure. Other nations are making similar AI investments. The US can't simply slow down without risking technological leadership, but racing ahead without addressing domestic displacement creates its own risks. The tension between maintaining global competitiveness and domestic stability may prove impossible to resolve satisfactorily. The corporate governance question becomes central. If companies can generate profits while shedding workers, what obligation do they have to consider employment impacts? Shareholders demand maximum returns. Executives face pressure to adopt automation to remain competitive. The incentive structure pushes relentlessly toward labor reduction regardless of social consequences. The market failure here is that individual rational decisions aggregate into collectively destructive outcomes. The measurement problem undermines policy responses. GDP growth that doesn't translate into broad prosperity reveals the limits of how we measure economic health. Employment statistics that miss underemployment and labor force dropout paint incomplete pictures. Productivity gains that benefit only capital owners get celebrated as unqualified success. Better metrics might enable better policy, but the political will to adopt them remains absent. An economy that grows without creating opportunity eventually loses both political legitimacy and social cohesion. The current trajectory points toward exactly that outcome. Rising GDP coexisting with declining labor market access, appreciated assets alongside deteriorating household balance sheets, celebrated productivity gains masking workforce displacement. The question isn't whether this creates problems, but whether the system can adapt before those problems become crises. The evidence so far suggests adaptation is not occurring at anywhere near the pace required. The historical precedents offer limited guidance. Previous technological transitions occurred over generations. This one may unfold in years. The speed differential alone makes past experience less relevant. We're navigating unprecedented territory with outdated maps. Before we close, one quick clarification. Everything in this analysis is based on public information, historical context, and independent interpretation. It's not a call to action, not an instruction, and not a claim about anyone's intentions. It's simply one perspective on a fast-changing situation. Reasonable people can see the same facts and reach different conclusions, and that's healthy. No matter where you stand, the goal should always be the same: stability, accountability, and peace, without fear or hate. You're welcome to share your own perspective in the comments, respectfully and thoughtfully. Thank you for watching and for thinking critically. Subscribe for more calm, fact-driven deep dives.